Thank you, and thank you all for coming to listen this afternoon. I'm going to talk to you about two things. Firstly, a fund that I run for Aberdeen, which is the Aberdeen Emerging Markets Investment Company, which, as the name suggests, invests in emerging markets. But more generally, to talk about emerging markets as an asset class, which perhaps wouldn't get as much airtime as it should at a retirement-based event, because I think it's often misperceived as an extremely risky asset class. So I was very pleased to have Baillie Gifford teeing me up with their 30% weighting to emerging markets, which we would wholeheartedly agree with as an appropriate kind of level. I've been running the fund that I'm going to talk about, or I've been involved in the management of the fund for 18 years, investing in emerging markets for 18 years, and I did have a full head of hair when I started. So I'm going to talk about specifically the long-term investment opportunity, and I think this is really relevant, particularly in emerging markets, because they can be volatile, but also relevant in general because people's investment horizons seem to be getting shorter and shorter, which I think, if you can take a long-term view, gives you a real added advantage. So why would you invest in emerging markets when there are so many good reasons that you can regularly read about in the popular press that would keep you out? Cutting right to the chase, this slide, I think, highlights why you would want to invest in emerging markets. So the asset class as a whole has a track record now of nearly 30 years. That makes it nearly as old as private equity, nearly as old as listed real estate, nearly as old as a whole swathe of very, very core mainstream asset classes. So this is not an emerging asset class anymore. It's actually a very established asset class. And the key point here is that, yes, emerging markets can be volatile. Yes, they can have bad years. But your average up year in emerging markets over those 30 years has been 40%. Contrast that with the all-share, 18%. Your average down year when emerging markets have gone down is minus 16. In developed markets, in the FTSE all-share, again, about minus 13. So when emerging markets go up, they tend to go up an awful lot. And this is typically what we see as people out of emerging markets for the wrong reasons at the wrong time. And by that I mean that quite often we see people avoiding this asset class when it's out of favour, when there are negative headlines, when you're reading on the front page of the broadsheets that something terrible has happened in China or Korea, or that people are building bridges to nowhere, or that there's a political scandal in Brazil. And as I'll develop a theme as we go through the presentation, that those are exactly the moments when we think you should be investing. It's very hard to do it, but if you can reap some very significant rewards. So over the 30-year period, or the 29 and 11 months that we're talking about, and I should have said that year to date, emerging markets are up about 25%, the all shares up about 13%, which again, at the moment is prompting a lot of people to say, well, I've missed the boat. I wish I'd bought in 2016 when the news was really bad and when a lot of people were saying, well, emerging markets as an asset class are just going to cease to exist. I mean, that was one of the most ridiculous things I've ever read, that this massive asset class that covers the bulk of the world's population, that encompasses 50 countries, is somehow going to cease to exist. It's just inconceivable, but journalists do sometimes write things that are inconceivable, as do US presidents. So this year, another good year, but really just an average up year for emerging markets. So we don't think it's too late. Another thing I love that took me at least the first 5 years of my career to learn is this, the eighth wonder of the world, the power of compounding. You could be forgiven for looking at these numbers and seeing that emerging markets have annualized 12% over the last 30 years. 12%, not bad. I probably made something similar in real estate. But if you've been there since day one, you're looking at a pretty staggering number. And equally, we hear a lot of people say, and our last speaker, I agree with a lot of what you said, the UK as an investment destination, we invest in the UK as well. I agree with everything you've said, but it doesn't take too much of a premium over what you get from investing in the UK to add up to a very, very significant level of outperformance over the long term. So we're invested in emerging markets. We love emerging markets. We think they're often misunderstood. Why? Besides the returns, should you invest in emerging markets? We think it's about growth. We look at growth in terms of the company level and then in terms of the country level. What excites us at the moment about emerging markets is that after 5 consecutive years, which were very painful years of famine for emerging market fund managers, you had a consistent rush towards the end of each of the calendar years leading up to the end of 2015 for analysts to revise down earning revisions, start very optimistic, and then as the years went on, every time you saw downwards revisions, downward revisions. And a lot of that was to do with emerging market currencies, which when you take your Brazilian company earning in real and you translate those earnings back into sterling or dollars, and you've got a weakening real, weakening, it's very hard for them to print a positive number in a hard currency like sterling or dollars. This year and last year were the first time in a significant while that we've had the opposite. Emerging market currencies have found a floor. That has given the many, many good companies that exist in emerging markets the ability to print positive earnings growth for the first time in a while. So this line up here for 2017, you can see about 20% earnings growth. That's some of the fastest earnings growth you'll find anywhere. And you're not having to pay a particularly high multiple to get access to that growth. And if you look back at when we launched our fund, we launched the fund in 1998. The share price is up 700% since we launched it, and the valuation in emerging markets is still about the same. So that tells you that actually the really long-term opportunity in emerging markets is earnings growth. You're delighted if they trade at a very high valuation at some point in your holding period because it will give you an opportunity to sell. But actually, if valuations just go sideways, you should still make very good money because there's a phenomenal earnings growth opportunity in emerging markets, which we're not alone in having identified. A lot of people like to talk about GDP growth. It's not as correlated to stock market performance as this earnings growth, but it is at least encouraging to see that emerging markets are growing again at a level, at a speed which is more rapid than you're getting in the developed world. We wouldn't put too much emphasis on this, but we do believe at the end of the day you want to invest in economies that are growing rather than economies that are shrinking. You very rarely make money in countries that are in recession. And then, as I said, you're not having to pay a particularly demanding multiple to get into emerging markets at the moment. This chart shows the relative valuation on a price to earnings basis, which is the blue line, and a price to book basis, which is the orange line, of emerging markets relative to developed markets. And you can see very clearly that this has been fairly cyclical over the very long term. There has been a distinct trend for emerging markets to trade at a discount to developed markets, but at times you will get very significant premiums applied to emerging markets, which is when investors are generally getting very, very overexcited about the prospects for the asset class. And you've had some good performance, and people extrapolate that performance and say, well, we're going to get 20% earnings growth forevermore in emerging markets. And those are the points when you should sell. And I won't be able to stand here and tell you that we think there's a good opportunity. At the moment, though, a 30% discount to global equities, which look to be reasonably fairly to fully valued. And we think there's a lot of catch-up that can be done if that earnings growth continues to come through. So how to access the opportunity presented by emerging markets? Again, this is kind of 18 years of practical experience distilled into 4 bullet points. And I think each of those points talks to one of the key aspects of the way we manage the fund, which is quite unorthodox because we're a fund of funds. Being contrarian is key. As I said, you very rarely get rewarded for buying the latest hot thing. So again, coming back to the bat fangs, I'd heard of the fangs, I hadn't heard of the bat fangs or the fanged bats yet, but I'll remember that. So this is really not the time, we think, to be running out and buying a China-specific tech fund or an India-specific tech fund or a Bitcoin investment trust. This is a case in point. Again, I don't have a particularly strong view on Bitcoin other than it has a lot of hallmarks of something that's very overheated, but it's a very relevant example at the moment. There is an investment trust, if you want to buy it, listed in the US. They call it an investment trust. It's not really like our UK investment trusts, but it's listed on the New York Stock Exchange. It just gives you exposure to Bitcoin. And if you didn't think Bitcoin was expensive enough as it is, you can go and pay a 60% premium to asset value to buy a Bitcoin investment trust, which, based on our previous experience, is never a good thing to do. We have in the past seen Chinese funds trading at 50, 70% premiums in the US market, where the retail investor is a little more irrational than you good people based in the UK. But to give you a flavour of the kind of things we like, where are we putting our money at the moment? Well, we're putting money into Africa. Africa has once again been written off as an uninvestable destination, and we think that's very wrong. There are a good number of extremely well-managed, extremely long-established companies operating in Africa that have been extremely depressed because African funds have had outflows on a fairly consistent basis in every single one of the last 5 years. That's down to commodity weakness, currency weakness, and those themes have now played out. So we've been putting money into Africa. We've been putting money into markets like Romania. We've got exposure to markets like Argentina. These are places that scare some people, but what we can see is that they're unpopular, they're unloved, people aren't chasing them, and because of that, you're generally getting in at very attractive valuations. And when we're buying other funds, we prefer to buy them at a significant discount to their intrinsic value, which you're able to do when you're not in a crowded market. Second point is key. Diversification is the best form of risk control. We intentionally have a diversified portfolio because as much as we spend our entire time worrying about emerging markets, emerging market risks and what we own, we can't predict the future. We have no way of knowing what Donald Trump may do that could impact the outlook for emerging markets. We have no way of knowing what may happen in the next Brazilian election cycle. We can analyse them until we're blue in the face, but I think as Brexit and Trump's election proved, just in the very recent past, these things are almost impossible to predict. So have a diversified portfolio and maintain that diversification. Get exposure again to a very broad opportunity set. By all means, invest for income, but particularly where emerging markets are concerned, we think people should be aware that it's only one component of total return. So we, on our fund, pay a yield of just over 3%. But we wouldn't profess to think that that is the driver of our opportunity set. Consistent with the example just given on Bovis, we don't invest in Russia because we think we're going to make a 4% dividend yield on a consistent basis. We invest in Russia because we think a 4% dividend yield is nice. It may attract other investors in, but we invest in Russia because we're expecting to make high double-digit returns over the long term because it's such an attractively valued market. And finally, and not to be under-stressed, invest through appropriate structures. So I'm delighted that everyone presenting so far today is running investment trusts. We love the structure. Why do we love it? We list 10 reasons here. Aberdeen Standard obviously manages a large range of investment trusts. They like them too. It's where Aberdeen started, actually, as an investment trust. And the structure does have a swathe of very, very positive points going for it. And as a result of these factors, it is a widely held belief, and it can be backed up by evidence, that investment trusts tend to outperform open-ended funds over time. And this is true nowhere more than emerging markets, which makes sense because it's a volatile asset class. You don't want inflows, you don't want outflows on a regular basis. You want a stable capital base from which to invest. You want to be able to buy liquid stocks because they tend to trade more cheaply than very liquid stocks. And the two that I've highlighted here, Global Emerging Market Investment Trusts and Asia-Pacific ex-Japan Investment Trusts, which are the two groups that make up the bulk of our universe, have consistently outperformed equivalent open-ended funds, particularly over the long term, not least because they can be geared and because they don't suffer the costs and the disruption to the portfolio of constant inflows and outflows, which tend to go in sync with sentiment towards the asset class. So you always get the outflows when you least want them. You always get the inflows when you least want them. That much, I think, will probably remain the case for as long as we're around. I'm going to skip that one. So coming on to the fund that I help to run. It's a £380 million fund. It's listed on the main market of the London Stock Exchange. We had the good fortune to be listed in 1998, just before the Russian crisis, where our share price promptly went down 40% to about 60p, and our share price is now £6.50. So a painful anecdote, but one which I think highlights the point. The best times to invest in emerging markets are when people are throwing the baby out with the bathwater, when nobody has positive things to say about the prospects for the asset class. The best time to sell are when there are billions and billions of pounds being raised for the latest emerging market funds, when we think valuations are almost certainly going to be too high, and you should be thinking about taking some money in. So what do we offer? We offer a very diversified exposure to emerging markets, global emerging markets and frontier markets. We currently have about 9% allocated to frontier markets, some of which I mentioned earlier. I think a very reasonable cost structure. We've recently reduced our fee from 1% to 80 basis points. Our ongoing charges ratio, when that's fully reflected, would come down to about less than 1%. Active versus passive is a debate that rages on. I think in emerging markets, the passive argument is relatively weaker compared to, say, buying an S&P 500 ETF because investing in emerging markets is pretty expensive anyway, however you do it. So it's not uncommon to see an ETF in emerging markets with an ongoing charges ratio of 50 to 70 basis points. So I think good value. As I mentioned, we pay a dividend. We pay that quarterly, and it totals about just over 3% per annum, which is nice to have. And we have all the usual Aberdeen standard saving schemes and ISA wrappers, which I think in a volatile asset class are probably the single best way to invest, dripping money in on a monthly basis over the long term, capturing those returns, and that all accumulates very nicely. It's the first way I ever invested in an investment trust, and it happened to be through Aberdeen Standard. And that scheme is still running today. It's much bigger than it was then. So here's our portfolio. So we're relatively concentrated. We have 33 holdings. The top 20 account for nearly 90% of the portfolio. Obviously, on a look-through basis, it's much more diversified than that. We can invest in open-ended funds and closed-end funds. The benefit of that is that we can buy closed-end funds when they're very out of favour, when markets are out of favour. Even good managers trade at discounts to asset value if their strategy, if their structure, if their markets are out of favour. So we love to buy closed-end funds when that's the case. Open-ended funds we own for liquidity, and also because quite often the best manager in Thailand or the best manager in Indonesia doesn't happen to run a closed-end fund. He happens to run a portfolio of $100 million based in Jakarta that London-based investors have never heard of, but where we've been met, done the due diligence, and I think that they have a fantastic chance of outperforming the general market over the long term. Our fund trades on a discount to NAV of 11%. Our underlying portfolio of investment companies and closed-end funds trades on a discount of 10%, and that means that all in, you get to buy a pound's worth of assets for 84p, which we think again is a very good extra layer of value when buying an already attractively valued asset class. This would probably be difficult to read from the back, but basically the areas we like at the moment, we're very overweight emerging Europe, particularly Russia. We're overweight Turkey, we're overweight Romania. And the areas we're underweight would be mostly Asian markets, including Korea, India, and China. We do like China. We have a quarter of the fund invested in China. We are believers in the long-term prospects for that market, but we struggle to get so excited that we're willing to allocate more than a third of our fund to a single market. Coming back to my point again, that as much as we like China, things can go wrong, and China has a good history of having a hiccup once every 5 to 10 years. We haven't had one for a while, but if you cast your mind back as little as 2 years, China was pretty much considered a no-go zone by a lot of international investors. We think the progress made in the last 2 years has been fairly phenomenal, and you have had some incredible stock market returns. Our long-term performance track record here. Our approach to performance is that we're not trying to shoot the lights out. We have a diversified portfolio, as I said. Coming back to the power of long-term compounding, we think if we can outperform by 1 to 2% per annum over the long run, that adds up to some very nice numbers. So you can see since inception, we've beaten our benchmark by 2.2% on an annualized basis, which gives you this very nice trend of outperformance over the long term. But we will never be the fund that delivers you index plus 10 to 15% in any given year. Equally, we'll never be the fund that delivers you index minus 10 to 15% a year. How does that compare to some of our peers? We're a relatively small team. We have a pretty unique approach, but it does stack up extremely well relative to some of our big brand peers. Here we have the likes of Templeton and Gempleton. I can say that because they're not presenting. Templeton, JP Morgan, Genesis, and I think what we're very encouraged by is that our approach seems to be delivering, and long may it continue. Better returns, both than the sector average and a passive approach, but also with a lower level of volatility, which comes from being diversified. At the moment, our struggle is keeping up with the FANGs, where the share price charts look pretty stratospheric, and we don't own enough because valuation-based investing tends to exclude companies that trade at those kind of multiples. So to wrap up, we love emerging markets as an asset class. We have a significant amount as a team of our own money invested in this fund and emerging markets. We believe in the long-term opportunity, but we fully acknowledge it will be volatile. As investors in this asset class, we think the best way to approach that is to make volatility your friend, not to run away from things when they're bad, but to actually go in the other direction, sell when things are incredibly hot, buy when they're extremely out of favour and unloved. And over the long run, we think that's an approach that really works. Invest through appropriate structures. So we think closed-end funds are exactly the reason that investment trusts were launched for asset classes like emerging markets, because they can be volatile and because the benefits of that structure work really well in volatile asset classes. And our fund is one such fund, and a fairly unique proposition because of the way we do things. Thank you very much for listening.